Hello, everyone. Welcome to OpenLine. Glad you are with us. We are talking tonight about your money, about investing our money. And this is a chance for you to call in with any questions that you have about the current situation, about anything, IRAs, all these things. Happy to have with us Paul Winkler, financial planner. Paul, thank you for being here.
Yeah, good to be here. It was snowing, so we had to do this thing.
Yeah, we were going to do it last night.
I know. Well, this is great.
And I think I always learn something. You bring your whiteboard. If somebody calls in and they want to write it, have something, that's always helpful too.
We might be able to draw.
Yeah,
because people are visual.
Yeah. And add and subtract or whatever we need to do.
For sure.
So let me start with this big picture.
Yeah.
The current environment for investing is what? What would you say?
Yeah, that's an interesting question, because typically what do we think of when we're thinking about markets? We're looking at what's going on around us, what's happening right in front of us, what's the economy doing, what's Washington doing? What have we been hearing for months now? MAGA, make America great again. Let's, focus totally on America. Let's really, really America-centric. And what's so interesting is people think, well, man, it's time to invest in American companies. That's what we ought to be focusing on, is the U.S. stock market. And typically, if you look at fund companies, the Vanguards, the Fidelities, the American Funds of the world, whatever fund companies, it doesn't really matter. Typically, they focus mainly on American companies because that's what Americans are really, really focused on themselves. That's who I know. I know who Microsoft is. I know who Amazon is. I know Walmart. I know all of these companies. But what happens is markets will actually digest information as it comes in far before anything actually really happens. So what has happened so far this year, and this doesn't mean, hey, guys, go out and change your portfolios to chase this, because that's another tendency we have. But international companies have actually been trouncing U.S. companies so far year to date. And most American investors are not very well focused on that market segment because we don't think about it. We don't think about when's the last time you heard anybody talk about the Europe, Australia, Far East, the EFA index, and tell you what it closed at today? You hear the Dow, the S&P 500, the NASDAQ, American. So that's what I think is so interesting right now.
That is very interesting. And I know you're somebody big on diversify and don't have all your eggs in one basket. Don't put all your money in one bucket. But so are you saying what we need to be thinking about is diversifying as far as national and international?
Yeah, certainly. So if you go back to the 1950s, and this usually blows people's minds, 1956 is when we started getting data on Great Britain, British stocks. So we have good data on British stocks, not necessarily a lot of the other established markets, but really good data to 1956. If you took $1 and you put it in large British companies in 1956, and you put $1 in large U.S. companies, it would have grown to about the same thing right now. And you'd think, well, wait a minute, didn't U.S. do way better? Oh, yeah, we're a way better economy, no question. But that doesn't mean that those companies don't have to pay to use your money as well. And that's what investing is. So if you take that and you look, well, what happened from that period of time till now? About the same return within just a tiny fraction of a percent. But during different decades, different companies in different countries did better. So if you look at the 1970s, international stocks did way better than U.S. stocks did. The early 1980s, U.S. companies did better than British companies. The late 1980s, it was the other way around. And you're starting to see a pattern here, right? Mm-hmm. It goes back and forth. But what's critical about that is if they end up in the same spot. If they end up in the same spot, but they got there in a different way, when I own both of them, I have less risk because they tend to offset each other. And you could predict it and say, I'm just going to get in this one, it's going to do well. That'd be great, but you can't.
Right.
So don't, perish that thought.
That's why you're all about diversity.
Yes.
Ups and downs, all that. Tariffs.
Yes.
The last thing on this, tariffs. Are tariffs impacting any sort of the investment world at this moment? There's talk of tariffs. Sometimes they're on, sometimes they're off. You're talking international have done slightly better. Are we seeing any impact right now as far as tariffs?
Yeah, if I were a guessing kind of guy and just say, because you can't really see clearly exactly what's happening underneath the surface. But if you look at it and say, well, why would international have done better when all the tariffs would be on international companies, right? And I think there may be a couple things at play that I don't invest and change based on my guesses like this, because it's a guess. It's a bad way to invest. But if you were just to say conjecture, Paul, what do you think it might be? It may be that the tariffs didn't end up being as big of a deal as people thought they would be, and therefore not as big of an impact on those earnings of those companies overseas. So therefore, hey, when it's not as big of a deal as we thought it was going to be, that edges them up. The other thing is, what are the implications and what are the possibilities of the war over in Russia and Ukraine starting to ramp down? If that starts to happen, who was most impacted by that? Those countries. If they are less impacted because maybe that starts to ramp down, who knows? I mean, that's just a conjecture as far as what might be happening. But tariffs, that's really what it gets down to. And where tariffs can be super, super interesting is a lot of people are, when they go to their financial advisor and their advisor says, hey, tax rates are going to be going up, right? Therefore, you need to convert your IRAs to Roth IRAs. And that is it's a big push in the industry. And any time that I hear the government talking and saying, hey, maybe you ought to convert your IRAs to Roth IRAs, anytime they're both on the same page, I worry, because who benefits when you do massive conversions? The federal government, because they get the tax revenue.
Oh, wow.
But here's the thing that's so interesting about that. All of that advice has been based on the idea that tax rates are definitely going up in the future. You hear that, right? We need more revenue at the federal government. Tax rates are going to be going up. But one of the things that Trump said, and you don't know how far this will go, but it's just one of those things I watch and I think, how does the government think? If you look at what he's been talking about with tariffs, is a possible replacement for income taxes. So could there be some downward pressure on income tax rates in the future? Thereby being a bad idea, not necessarily the greatest idea, to go and convert a bunch of money right now at higher tax rates when possibly the tax rates are lower in the future. So typically what you do to protect yourself from that, because we don't know, right?
Right.
Well, what do you do when you don't know what markets are going to do? You diversify. You do the same thing when it comes to taxes. So I'm really big on making sure that we have tax diversification in somebody's financial plan as well.
All right. Normally, I ask a bunch of questions, then we start taking calls.
Yeah.
We already have a call here. Let's go ahead and take a call or so here. We have Martha on the line.
Good evening.
Hello,
Hey,
Martha. What's on your mind?
I purchased a variable annuity long before I heard all the different investment coaches indicate that that's not the way to go. This was back in 2002. And my thoughts today are I either should have not purchased it at all or I should have purchased more of it, because a lifetime income, at that time I was told I would be getting $10,000 a year. And $10,000 a year is nothing to sneeze at, but it's not, if I put in more, I would be getting more and whatever. And I've just gotten to the point where I've started to annuitize. And I had a conversation yesterday with someone at the insurance company, because what I wanted to know is I was very naive. I was not told that the biggest winner in this whole thing would be the guy that sold it to me based on the commission he received. And so as a result, my whole deal was, okay, I want to get past the surrender periods and to the point where I'm starting to get the insurance company's money and not my own. So I thought from the phantom figure and the lower figure and all this, there's no way to possibly calculate at what point that happens. So what I ended up doing was just for my own, just to get a rough idea, I just took the amount I put in and kept subtracting the amounts I was getting back to date, and then I just figured when I reach zero, I'm starting to get my own money. I mean, that's oversimplified, but
okay, all right.
give me a rough idea.
And is that your question?
No, so my question is, yesterday I called the insurance company to ask that specific question, and I spent an hour going round and round with this guy, and from the way it ended, it sounded like there will never come a point where it's all my money. It's always going to be like a small percentage or something of their money or my money or something. And I'm just wondering if Paul can shed any light on that. Is that absolutely true, that you never reached a point where you get all your money back?
With an annuity.
Martha, yes. What a great wild question. Okay, so what you actually have is not a variable annuity. It sounds like it might be an index annuity. It may be a variable. You might have an income rider. It might be that. But anyway, so what she's talking about, which I love, she's gotten into this. She has an account, and this is where people really get fooled with these products. You put money in. And what happens, that money, it'll go up and down based on whatever investment's in there. If it's a variable annuity, basically what that means is it's using mutual fund type investments is what's going on. Now, if it's in an index annuity, it's a whole different deal. It's way too complicated. I'm not getting into that here, and it doesn't really matter. Then what happens is it goes up and down. Now, you have this phantom account that she referred to, and I love that she called it a phantom account because that's what it is. It is fake money. It is so I put $100,000 in. Just let me throw that number out there. And there are people out there that say, hey, you're going to get a bonus on your money. You give us $100,000 and we'll give you a 30% bonus. Now you have magically $130,000. And we'll give you a guaranteed rate of return on it. Some of them just do a guaranteed rate of return at 5%. I've seen 7%. I've seen different percentages. So this money here is going up and down based on the investment, whatever the investments do. This one's going up no matter what happens. It doesn't matter if the market crashes and totally goes to nothing. This goes up, supposedly, is the idea behind it. What we're going to do is we're going to base your income off of this number here if this number is really low. And usually that's what I've seen historically, is that you typically find the investment performance isn't anywhere what you thought it might be. Well, what I have done in the past is I've taken this number that they told me that they would pay me on this amount of money, and I've gone and said, well, okay, how much money are you going to give me? Let's say it's $4,000. And then I've gone over here and said, well, what if I take this money, even if I lost money, and I take this money and I hand it to a third-party insurance company and say, what would you pay me on this amount of money? And I've actually found that the income on this smaller amount is often higher than what they'll pay me on this side. And you go, well, wait a minute. It is because, as she said, phantom money. Well, people get fooled by that because, hey, it sounds like my money's going up and up and up and up. Now, when do you ever get your money back? It really, really depends on your life expectancy and how long you live. So what ends up happening is I take this lump sum of money, and let's say I talk about a straight annuity just to keep this super simple for the folks out there. And I have, let's say my age is 75 and I have a life expectancy of exactly 10 years. Now I give them $100,000. Let's say that I have a 0 rate of return on the underlying investments, just to keep this super simple for everybody. What they're going to do is they're going to take that and they say, your life expectancy is 10 years. You gave me $100,000. We'll pay you $10,000, $10,000, $10,000, $10,000. And if you live 10 years, you got all your money back. That was her question. If you live beyond your life expectancy, now you're starting to get a gain over and above what you gave them. You win if you annuitize. If you only live a couple of years in a regular straight annuity, you've gotten $20,000, $10,000, and $10,000, 2 payments of $10,000, $20,000, and money's gone. You lose. Who won? The person that lived beyond their life expectancy.
Wow.
Sometimes what happens with these products is when you annuitize, you may be getting, now there may be a tax thing going on here, where you're getting your principal plus a little bit of gain. And that I would have to, that would be something, Martha, I'd go, get with me. You can email me and send me the information, and I can look into it a little bit further for you. But I'd have to see what the payout is based on what they're telling you. But that is how I would analyze it. I would analyze it by taking the money, and there are on websites out there where you can do an immediate annuity calculation and do this on your own. If you don't know how to do that, I can teach you how to do it. It's pretty easy.
Bottom line, you were not a fan of annuities. And even she's saying she regrets she did an annuity, is what it sounded like.
Well, they're a distribution vehicle. It's a way of getting your money, and distributing it throughout the rest of your life. They're almost never used for that. The statistics are well less than 10% of people ever annuitize, which is what they were designed for. There was an attorney that was teaching out. He was out at the Memphis Elder Law Institute. a little while back, and he basically said they are uniformly horrendous products.
Oh, wow.
As an accumulation vehicle, that's what he was talking about. And there's so many. There's so much smoke and mirrors going on in them. I'm not a big fan, and I'm not a big fan of the advisor being paid on commission either for that reason, because there are so many ways that the investment advisor even gets fooled on these products.
Oh, no. Okay, Martha, thank you for that question.
Great question.
We have others on the line, but we need to take a break. If you want to call in, there's the number, 615-737+, 615-737-7587. We'll take a break. Be back right after this. Welcome back, everyone, to Open Line. Talking with Paul Winkler, financial planner. We're talking about your money. Last caller asked about annuities. That was a very interesting discussion. Let's just go back to the phones here. Let's go to Kevin, who is on the line. Hello, Kevin.
Hey, Kevin.
Yes. I'd like to ask him a throwback question to the mid-late 90s. He's a young gentleman like me. I'm going to be starting to get my old $1,800 a month here when I turn 62, May 31st. And the girl said I'm fortunate because I got the last day of the month. I'll start getting in June instead of May. And she said, listen, you can take $1,500 now, wait a year, get $1,800, or wait 2 years and get $2,000. And I know people that always say, take it. And I want to take it because I could use that money. So...
You're talking about retirement age, like when should you take Social Security?
I think I got it.
Kevin, thank you.
So Kevin is saying, I think he said he was 62.
That's what it sounds like.
It sounds like that. That's what it is. The way Social Security works is you look at your full retirement age. Now, for Kevin, it would be 67, based on what he said his age is. So that would be full retirement age. When you take it early, each month that you take it early, you have a 0.5% penalty for taking it early.
Okay.
So to speak.
Okay.
So if I take it 3 years early, you do the math. If I do it 36 months early, 3 years early, you'll have a 20% reduction in your benefit. Okay. Now, every year that you take it prior to that, you're going to have another, you'll have another 5%, off of it, reduction in your benefit for life. Now, here's what happens. So if you take it at age 62, let's say you take it at so let's say we do that. You'll be taking a penalty when you take it early. Let me just hit his main question, because that's really what's important. You have that penalty for life. If you take it prior to age 67, you could have a work penalty. If your income exceeds, let's say you have work income and it's like $22,000, I think it is right now. For every dollar you earn over that, every $2 that you earn over that, they'll take away $1 of your Social Security, is what ends up happening. So if you're not going to work anymore, you might take Social Security if you don't have any other avenues. If you are going to work, they're going to penalize you. What they will do, though, is let's say that you do start take your Social Security, and then you go back to work if you're not working now, and they penalize you. And let's say that they take away 1 year's worth of benefits from you in this whole process up to age 67. What they will do when you hit 67, they will increase your Social Security benefit as if you were 1 year older. So some of those penalties that I talked about would go away, and your benefit would actually increase at that point. But here's the thing. A lot of people will say, take your Social Security early. It may not be there in the future. The trust fund's going broke.
Right, they do.
And the point that I make with people is this, is if you take your Social Security early, you are penalizing yourself for life by having a lower benefit forever from here on, versus your benefit if you wait, if you can wait. Now, here's what happens, is that your benefit goes up by the cost of living, by a COLA, by an inflation rate, and an inflation rate on a higher number is a higher amount of money. So you can have a situation where if you wait, your benefit goes up more because the cost of living is higher on that higher number. But people say, take it now while it's still there. And my point is this. If you look at Social Security, let's say that they make some changes in the future, they're not going to go, the only people that are going to are dinged by those changes are these people that waited. They will do where everybody comes down by that amount. So the best estimate is that in the future there's a possibility, and probably not going to happen because the government will get their act together at some point, but there's a possibility of everybody's benefits going down by 21%. So that would be where I would be really, really thinking about, and think about your numbers. For some people, taking it early makes sense based on their financial situation, but that's something where in the financial planning process, I'm looking at and going, hey, does this make sense for you?
Right.
Are there other sources of income to tide you over? And sometimes what I'll do with people is I'll take money that they have in non-qualified accounts or other accounts that are accessible, and I'll spend those down to buy the ability to put off Social Security so I have that higher benefit for life. And this is especially true, I will often do this, if I have a spouse, let's say a husband and a wife, let's say, and one person's benefit is much higher than the others because the survivor between the two of them is going to get the higher benefit.
Oh, wow.
So we will often push that off, but it really depends on the person's financial plan. But I hope that answers that question.
So you obviously are of the mindset, wait as long as you can. You're not
sometimes.
Sometimes.
I mean, you know, nothing's hard and fast. I hear people say, always do this, always do that.
Right.
And I'm like, no, that's really bad advice.
Retirement age has gone up to 65. I think I remember it.
65, and it went to
65.
Yeah.
Now it's 67.
Other people are talking. There was a study that was done recently, and they were talking about younger people. The vast majority of younger people actually think it's going to go up even again further in the future.
Right.
But the issue is this: how many people are working in jobs that their body won't hold out until age 70. You know what I mean? So you have to think about those things. So I think there's going to be a lot of thought that goes into that before they just go and raise the age.
Good call from Kevin. We've had a good call from Martha, a good call from Kevin. All right.
I love it.
All right, yeah, give us a call if you want, 615-737-PLUS. Want to ask about required minimum distributions.
Yeah, that's a good question, yeah.
So RMDs, what are they? Let's just 101. Basic stuff. What are we talking about here? Why are they important?
Yeah, so required minimum distributions, when you put money in a retirement plan, an IRA, a traditional IRA, or a traditional 401k, you're saying, hey, I don't need this money right now. I'm going to need it, though, in the future. So the way our tax system works, you'll have, here, whiteboard.
We're going to use whiteboard.
I knew we'd be able to use this whiteboard.
I like the whiteboard.
So what happens is, the way our tax system works, your first income is taxed at 0. Your next income is taxed at 12%, and then 10%, and then 12%, and then 22%, and then 24%. It goes up to 37%. Okay?
Okay. So it's not the easiest to see, but that's the highest.
Not easy to see, but let's see if I can get this where there's not
so you
glare.
see they're different levels.
Different percentages. Cool. Okay. Now, when you're working, you're taxed up here at these higher rates. Your last dollar is taxed at that rate. When you get to retirement, you're taxed at these rates because you don't have income from work anymore. So what a traditional or a pre-tax 401k does says, hey, let me avoid this, and then later on when I really need the money, I'll take it at this, and that's called tax leverage. You're leveraging your tax rates.
Okay.
Now, what happens is the government goes, hey, you know what, that money that you put away in your 401k, we never got any of that, and we want to get some of that. So they're going to force a required distribution on your IRA or your 401k when you get to certain ages. Forever, it was age 70 and a half.
Okay.
Then it went to age 72. Then it went to age 73. So, if you're born in the 50s, it's 73. If you're born in the 60s or after, it's age 75. So you can put off taking that money out. Now, the way they calculate it is really weird. What they do is, I don't care if you're single, if you're married, they will say, okay, you're 75. We're going to act like you're married to somebody that is 65. And we're going to take your joint life expectancy of you two people, and we're going to make a distribution on that. So approximately, the joint life expectancy is in the neighborhood of about 26 years.
Wow.
Okay. So if I take an account value, $100,000, let's say, because that's been my number of the day, divided by 26, it's approximately 4%. Okay? The one thing that's really interesting on how RMDs were actually done is what I like about them is you can't run out of money. Because that's what everybody worries about. What if I run out of money? What if I
Sure.
run out of money? If you have an investment account and you're taking a percentage of whatever's there, how you don't run out of money. You see what I mean?
Oh, I see what you mean.
Yeah, so if you have a thing,
taking 4%, eventually you'd run out. But you're taking 4% of the next 4% of the next 4. I get it. You would never run out of money.
And your percentage goes up because your life expectancy, your joint life expectancy, is going to go down. If you're 75, it's 60. It's 75 and a 65-year-old, 76 to a 66-year-old, 77 to a 67-year-old. You see, and eventually, when you get to in your 90s. Your actual life expectancy for a 92-year-old, believe it or not, and 92 married to someone who was 82, remember, right? It's about 10 years. So you'll take about 10% out. Now, what's really interesting, and maybe after a break we'll get into this, is we have audited returns on investment portfolios that are managed very academically versus how if you had just put your money in CDs and had done this. What's the difference?
CDs.
Oh, yeah. You'd be surprised how many people, that's what they do. They are worried.
We talked about that last time. Yeah, I mean, my grandparents did that. There was I don't know about a lot, but they definitely put money in CDs. And I think they had been through the Great Depression and all that, and they thought this is stable.
Well, you think about the stock market. Why do people get scared about the stock market? Well, because they have seen other people that have lost everything. Mm-hmm. Well, or they have lost a lot of money in the stock market. And my input on that is the reason that most people get very bad results, and the studies prove it, they bear it out, that the studies show that investors get really bad returns in the stock market historically. There's Dalbar actually did a piece of research on this. And they went back 35 years. I think they're up to almost 40 years now on their research. And they found that the average investor in the stock market, in an asset allocated portfolio, got about the inflation rate. It's really bad. And this is what frustrates me is the investment industry says, well, see, investors are getting bad results. We're here to save the day and come in and fix it. And my point is, no, you guys have been managing most of the money over these 35 years. The problem is the way most people approach the stock market. They approach it like a gambling casino. And what they'll do is they'll say, hey, what do you think the market's going to do this year? Hey, what do you think is going to happen with Trump this year? What do you think is going to happen over in Europe? What do you think we ought to be doing based on Federal Reserve policy? And I sit there and shake my head going, you know what? That is a waste of time. We know that people throwing darts at the stock tables get better returns than the professionals do. So what we've got to do is we've got to approach investing differently. And the way you approach it is through making sure that you're buying funds and investment vehicles that are not engaging in that activity. And there are a lot of them out there. Because of the research, a lot of people have actually gone, whoa, wait a minute, we need to be doing things differently. And that's really how you approach taking income in retirement as well.
Very interesting. So that is requirement minimum
distributions.
You never would lose money. Okay. I mean, you would never not lose money. You would never go broke.
Well, let's say if we had global financial Armageddon and the entire world went away. Yes, we can lose money in that case. That's for my compliance people. My compliance attorneys tell me, Paul, don't ever say you can't ever,
And so never is not right. Okay. But I see what you're talking about as far as the minimum distribution. It doesn't go away based on that.
Yeah.
And then you're talking about diversifying, that kind of thing as well.
Do you want me to hit that now, or do we have time?
Well, why don't we take a break and then the diversification. Okay. We'll take a break and then talk about the diversification. But that's a lot to take in. That's all.
It is a lot to take in, but we'll make it easy.
This is a high-level discussion, which I like. And those were two great questions. Give us a call, 615-737+. We'll take a break. Be back right after this. Welcome back, everyone, to OpenLine. We are talking with Paul Winkler, financial planner, and we're learning about money.
Yeah.
We have talked about annuities, required minimum distributions, and now I want to talk about basically your philosophy. And I've learned when you've come on about diversification.
Yeah.
Is that right? And so explain that and why that's important.
So there are three things that drive the vast majority of returns. There was a really interesting study, and I think it's so funny because how often we sit there and focus on, do I do pre-tax, do I do a Roth IRA, how do I, all of that kind of thing. The study actually showed that the biggest determinant of your success in retirement is the return of your portfolio, which I think is so funny because that's so obvious, right? It's like, yes, you get Mr. Obvious, you win a prize now.
Yeah. You want it to do well.
But you know, so how do you do that? Well, one of the guys I studied under who won the Nobel for economics, he won in 2013. I studied under him in the 1990s. But what he did is he said 95% of your returns are driven by these three different, he called them factors. How much do you have in stocks versus bonds? So you're a young punk. You got 20, 30, 40, 50 years before you're going to retire. It was mainly, you typically focus mainly on stocks because you're trying to protect yourself from inflation, which, what is inflation? Prices going up. Who's raising prices? Companies. What do you own when you own stocks? The company's raising prices. So you have those three things going together. Now, if I look at as a person as I get older, well, what does the stock market have? It has ups and downs. And you know, if we look at it, it goes up and it goes down. It's always come back. You know, New York Times had a really interesting article on you measure stock market downturns, not in years, but in days historically. And most people, that really blows their minds because they think, I'm too old for a stock market downturn. And I go, no, actually, if you look back at the history, you measure downturns in days, not in years. So in reality, even though days, it might be, 300 days, which is a long time. I need money during that period of time. So that's where bonds and fixed type investments come in things that are more safe and solid and secure. Now, you're not going to get much return on them. You don't have that inflation protection, but they do give you something to pull money from, when stocks go down. So when stocks go down, I can pull money from here to buy me time for when this comes back. And that's one thing I teach all kinds of workshops on. Why has the stock market always come back? It's really interesting as why that is. But here's the thing. When I get to retirement, I might have somewhere in the neighborhood of 60%, let's say, stocks to 40% bonds. One study showed that you didn't want any less than 50% or half of your portfolio in stocks on an income portfolio where you take an income up to about 70%, somewhere in that neighborhood. So what we did is we actually audit our client returns.
Okay.
We literally go in and audit, because how often you work with an investment person and you have no clue what their clients' returns have been. They just show you what funds are that they think you ought to be in, and you see what those funds have done, but they don't necessarily tell you whether they even own those funds when they had that performance. You know what I mean?
Right, absolutely.
Yeah, they may say, hey, I think you ought to be in this fund. Its return has been 15% over the past 5 years. Well, did you own it? Well, no, but but we actually, you have what's called global investment performance standards. And the last data I saw, I think it was only 4% of registered investment advisors actually audit their client returns.
And this is an outside independent audit that comes in and looks at this and then gives you the information.
Yeah.
And you can see how you're doing.
So what we did is we did a study, and I thought it would be fun. I told my guys today, do a study taking required minimum distributions from a 60% stock portfolio, 40% fixed income. Now remember, you're getting up to the point where you're taking a pretty good distribution out when you're age 90. You're taking out 10% of the money.
Yeah.
So you figure that it might go down. Well, if you put $1 million in the portfolio using a Gibbs audited 60-40 portfolio in all of this, what you actually have is about $37,000 was your first, about $38,000 was your first year's income. Now you increase it each year, you take it and you take it out based on whatever the account value is. Because remember, it's 4% of the account value first year, and it might be about 4.2% the next year, and it goes up because your life expectancy is shortened.
It's going down, yeah.
Right? Yeah, right. Now your income today would be about $73,000. Most recent year, $73,000, and you still had, on $1 million portfolio, you still had about 600 and I think it was 620. Yeah, you had 600 and no, excuse me, it's 78,000.
Wow.
I had the wrong sheet in front of me. The income you had taken was 1.5 million off of $1 million portfolio. Your ending account value is about 600,000. Okay, so what if you had done this with CDs? And that's what we ran. I thought, what would be fun to do that? What if we'd run CDs? $1 million, and we use treasury bills as the return of CDs, which are very much like CDs. Your income same amount of income taken out, but your ending account value actually went down to, and it ran out of money in 2022. It ran out of money if you had used CDs to take the same amount of income. Well, remember I said you can't run out of money, right? So if you take that distribution from the CDs every year, but it's only a percentage of whatever's there, your income would have been significantly less. You would have significantly less. Your income today would be the same as what you started with 25 years ago.
Oh, no.
Isn't that interesting?
So it's big, you're big, and you need to invest in the stock market, and these things prove out over time. The safe thing has been in the past CDs, but that's kind of, with inflation and everything, that just doesn't work.
It doesn't protect against inflation. So really, my whole purpose here is, because when we do this, I'm really hesitant to talk about returns and those types of things, because past performance, there's no guarantee of future returns. But you think about it, we've been through a 25-year period of rotten stuff with the stock market. And following the academic research and taking income in the manner that I talked about, worked pretty well. But it's based on data that goes back to 1900. A guy named Bill Bengen actually went and did the research on this stuff. And that's all we're following.
Would you say the last 25 years it's been a rotten time?
Oh, yeah.
Because isn't the stock market now higher than it's ever been? It's like at 40.
But look how rotten it's been.
But it's been tough. I agree.
You had the tech bubble burst, 2000 through 2002. You had the 2008 banking crisis.
Yeah.
You had the COVID period of time. You had a lot of bad stuff. So people have been through the ringer. 2022, where interest rates went up and stocks went down. But it's just, the point being is that I am really big on you follow the academic research when it comes down to investing. And what does the academic research say? Do what you've always been taught to do. Diversify like crazy. Own a lot of different things. Don't put everything in just CDs. Don't put everything in just an annuity. Don't put everything in, don't do these types of things. Follow that research. And, it has proven out to work out fairly well. But I like it that the RMDs, that the government, the system that they put in place actually works well with the academic research, is my point.
And okay, that's very interesting. And I also find it very interesting that these downturns are measured in days, you said, and not years. So even in some of these that we do remember, the stock market crash, we've had a few of them. We keep calling them stock market crashes. The big one would be the Great Depression back in the 1920s.
Right.
But then, we've had several. COVID, it went down dramatically, and the ones you mentioned, the housing crisis went down dramatically.
Yeah, so let's take a look at a couple of those. If you look at the Great Depression, you had 1929, 30, 31, 32. That wasn't days, that was 4 years, right? Now, when I'm investing and I'm making sure that I own a lot of fixed income in my portfolio, remember I used the figure earlier, 40% of my portfolio. If I'm taking a 4% distribution, how many years of distribution do I have in fixed income? 4 times 10, 40%. I have 10 years of distributions. We've never had a downturn that long, is the point I like to make to people.
Okay.
Now, in 2000 to 2002, that was a different deal. A lot of people went down that shouldn't have gone down. If they were diversified in 2000, the year 2000, value stocks, different area of the market, a lot of people didn't own, but that area of the market, which are distressed companies, believe it or not, actually went up in value. In 2001, small value companies, a different area of the market, actually went up anywhere from 20 to 30%. So if you look at that and you say, well, what if I own them both? Then maybe my downturn was only days. You see what I mean? If I owned them both because I had something that was offsetting.
What you had people doing back then was they were following the returns, right? Everybody saw that the tech companies were doing great.
Yes.
And so they go to their financial advisor and say, I want some of that. And everybody gets in the tech thing. And then the tech thing crashes.
Yeah, and that's what was going on in the late 90s. You saw, well, gee, we've had 10 years of great returns for technology stocks. This area is going to go to the moon. And then they jumped on board, and that's where you get into trouble, where you use past performance of an area of the market to invest. And that confuses people sometimes. They say, well, Paul, you just talked about past performance of a portfolio when you were talking about this. When I'm looking at past performance, I'm looking at 100 years of data. I'm looking at, when I look at large U.S. stocks, for example, you've got 100 years of data that tells me that that area of the market had a 10% return. How many actual years was the return 10%? Literally maybe one out of 100 years. It'll be up 30, it'll be down 15, it'll be back and forth. And what happens is that when you put that together with other market areas like British stocks, remember we started talking about how British stocks actually had the same long-term return. But remember, when we put them together, what did we have? Less risk. Because they didn't have their great, awesome days on the same days. But if I owned them both, any downturns that I had were much shorter.
You're not looking for the thing that's been going up based on past performance and dump everything in that. You would things that have gone down, invest in that. Things that have gone up, invest in that.
Yeah, very counterintuitive, but very intuitive when you think about it. What's the golden rule of investing? Buy low, sell high. So you're investing in something that hasn't done as well by definition.
And so what are the stock? I mean, this is interesting to me. Generally speaking, what is low now? And generally speaking, what's high? I guess you just said American stocks are a little lower, foreign international stocks are a little higher, but is that good enough, or are there other things that are lower? We talked about the tech stocks, back in the 2000s. Is there something like that now?
What has underperformed recently is really your question. And if you look at the recent past 4 or 5 years, international small companies. You never hear anybody talk about international small companies. Never. But, that area of the market, and how do you judge that it's quote-unquote low? And now, I'm not saying that it's selling for less than what it's really worth. When I say low, I compare it to something. So let's say that, Ben, you own a company. You own a company, and you own their chairs and their tables and your equipment and the building. That would be what's called your book value of your company. That's the stuff you've got. Right? Now, if you own this company, let's say it's a media company, you're not going to sell the media company for the value of their chairs, tables, and desks and all that stuff. You're going to sell it because you have customers and it's worth more. Okay? Now, what happens is that is what we look at in terms of what things are selling for, is what price compared to book value they're selling for. That's what I'm looking for. And what happens is if you look at large U.S. growth companies right now, the S&P 500, that's selling for about 4.5 times book value. Wow. If you look at international small value stocks right now, it's 81 cents. Significantly lower. Wow. So you would look at that and go, well, I'm not going to say, hey, take everything out of here and dump it in here, because you could have the next 4 years that this area actually does better because of AI. But I'm saying it's probably a good idea to maybe own a little bit of this, don't you think?
That's very interesting. Okay, all right, we're going to take a break. We'll come back, continue our discussion. We're talking all about money. Take a break. Be back right after this. Welcome back, everyone, to Open Line. Paul Winkler here, talking about money. And all right, diversification, annuities, we've hit all these things. I want to talk, for the moments we have here, your background.
It's been complicated. Today's been complicated.
Well, we learned a lot. Really I think it's good stuff. But what got you into this? What's your background?
Yeah, so I started off in insurance. My first thing that I did, life insurance, got my license to sell life insurance. Then I was like, I think I'll try property and casualty, auto and homeowners insurance, and then health insurance. And then, you get to where you can sell annuities. And I really became very, very jaundiced toward the industry, and decided that I was going to move away from that. I did 401ks, we did employee benefits, we did a lot of really complicated work. But a lot of the insurance products, I found that the promises that people were making weren't coming through. So I thought, I'm getting out of this. Well, I studied under a guy who, as I said earlier, was expected to win the Nobel for economics, and decided I'm going to open up a registered investment advisory firm. And what we do is when I represent the client, it always has to be in their best interest. We don't do anything. We don't ever take the hat off. In other words, operate on commission ever. Because I feel like it's just a huge potential conflict of interest waiting to happen.
Absolutely, yeah.
So what we do, we'll do Social Security planning. We'll help people with Medicare planning. If somebody has questions on auto and homeowners insurance or disability insurance or any of those things, we just don't sell that stuff. But I can give advice on the whole gamut of things. We deal with tax issues on when to take Social Security and how to do that. But that's really how I got into it. It was through that side. And I look back and I go, man, I'm glad I did. You know, just simply because there almost isn't anything like deferred comp plans and those types of things that people can ask me about that I don't know something about because I've probably set them up before. You know,
and there was a part of things that you didn't like, and you're able to not do that now. So there, you saw a side of some of this that you were like, I'm not going to go there.
Yeah, there were too many, you know, like for example, life insurance as an investment. You know, it was just a really, really bad deal for people. The insurance companies would promise the moon, and they would give them nothing. The annuities, they would promise high rates of return, then you look at the underlying account values, and there was nothing there. The mutual fund companies would say, hey, we can pick the best stocks. We can tell you where to get in and when to get out and do all of that, and then they would hurt returns through what they were doing. And then they had high expenses, a lot of hidden expenses that people were completely oblivious to.
Yeah.
You know, so that was it was a wake-up call to me that there's something wrong with this industry.
Yeah, the fees scare me. I mean, I don't have any idea about how to look at all that. Okay, all right, we're going to take a break. We're going to come back, and we'll look at where your locations are, where people can go to get more information. We'll take a break, wrap everything up right after this.